Reversal patterns. Reversal patterns show when the price is likely to change direction and move against the current trend. Traders look for specific shapes on the chart to spot these turning points early. The most common reversal patterns are double tops and bottoms, triple tops and bottoms, head and shoulders, and wedges. These patterns signal that momentum is weakening and a new trend may be starting. Breakout patterns. A breakout happens when the price suddenly moves strongly in one direction after a period of consolidation. Traders watch for chart patterns that hint a breakout is coming. The most common ones are wedges, triangles, and rectangles. When price breaks out of these shapes, it can start a new trend with strong momentum. Candlestick patterns. Candlestick patterns help traders guess future price moves by looking at the shapes of candles on a chart. Each shape reflects the battle between buyers and sellers during that time period. For example, an engulfing candle shows strong momentum towards the direction of the engulfing candle. Hammer and shooting star patterns showing rejection at a price level. A doji forms when the open and close are nearly the same, signaling market indecision. Fair value gaps. A fair value gap appears when a candle creates a noticeable price gap caused by strong buying or selling. To spot one, look for a candle with a large body. Then, mark the gap between the wick of the candle before it and the wick of the candle after it. This area often acts like a magnet, meaning price may return to fill the gap before continuing its move. Support and resistance. Support and resistance are key horizontal levels where price has reacted before and may react again. If the level is below the current price, it's called support, and traders may look for buying opportunities when price returns to it. If the level is above the current price, it's called resistance, and traders may look for selling opportunities when price moves up toward it. Dynamic support and resistance. Dynamic support and resistance work like regular support and resistance, but instead of horizontal levels, they use moving averages. Tools like moving averages act as shifting levels that price can bounce from as the market trends. These levels adjust with price, giving traders a flexible guide for potential buy or sell areas. Trend lines. Trend lines are diagonal levels that form during trending markets. They help show the market's direction. An upward trend line signals bullish movement, while a downward trend line signals bearish. Just like support and resistance, trend lines can offer entry opportunities. When price pulls back to the trend line, it may create a good setup to enter in the direction of the trend. Supply and demand. Supply and demand are zones where price has moved sharply. A demand zone forms when price pushes strongly upward from a level. A supply zone forms when price drops sharply from a level. These zones act like key levels, similar to support and resistance, and can be used to find potential entry points. Volume indicators. Volume indicators show the strength behind price moves by tracking trading volume. The most common volume indicators are price volume, which shows the volume of each candle. The longer the bar, the more activity. VWAP, volume weighted average price. It shows the average price based on volume and can act as a moving average or dynamic support resistance. Volume profile. It displays volume horizontally across price levels, helping identify key zones for potential entries. Momentum indicators. Momentum indicators measure the strength and direction of a trend, and they work best in trending markets. Some of the most common momentum indicators are MACD. An upward crossover signals a bullish trend. A downward crossover signals a bearish trend. Moving averages. Price above the moving averages suggests bullish momentum. Price below suggests bearish momentum. Oscillators. Oscillators show the relative strength of price and work best in choppy or sideways markets. The most common oscillators are RSI. When the line is in the oversold zone, it suggests a possible move up. In the overbought zone, it suggests a possible move down. Stochastic. When both lines are oversold, it signals a potential move up. When both are overbought, it signals a potential move down. The two lines can also cross to hint at upcoming price changes. Divergences. Divergences happen when an indicator moves in the opposite direction of the price. This often signals that the current trend is weakening and a reversal may be coming. Divergences can appear on indicators like MACD, stochastic, and RSI. For example, if price makes higher highs but the MACD makes lower highs, this is a bearish divergence. It suggests the trend may reverse downward, giving traders a possible sell opportunity. Market structure. Market structure describes how price moves and helps traders understand the market's direction. An uptrend forms when price creates higher highs and higher lows. A downtrend forms when price creates lower highs and lower lows. Break of structure. A break of structure happens when price breaks the previous high or low within a trend. For example, in an uptrend, if price forms a new higher high by breaking the last peak, that break is called a break of structure. It confirms the trend is continuing. Change of character. A change of character occurs when price breaks the structure against the current trend, often signaling a reversing. For example, if price has been forming higher highs and higher lows, but suddenly breaks the previous low and starts forming lower lows, that shift is a change of character, hinting the trend may be reversing. Fibonacci retracements. Fibonacci retracements use horizontal lines based on Fibonacci ratios to mark potential support and resistance levels. To use the tool, identify a swing low and a swing high, then drag the retracement tool from the low to the high. When price pulls back, traders watch key levels, especially the 0.618 level, which is a common reversal point. If price reacts there, it can offer a potential buy entry. Price can also reverse from other Fibonacci levels, so it's best to combine this tool with other confirmation signals for stronger setups. Elliott wave. The Elliott wave theory suggests that markets move in repeating patterns of 5 waves in one direction, followed by 3 corrective waves in the opposite direction. Traders label these waves as 1, 2, 3, 4, 5 for the main trend, and A, B, C for the correction. By identifying this sequence on a chart, traders can predict where price may move next. There are a few key rules. Wave 2 cannot retrace beyond the start of Wave 1 and often pulls back to around the 0.618 Fibonacci level. Wave 3 is usually the longest and strongest wave. Wave 4 must stay above the peak of Wave 1 and often retraces to the 0.382 Fibonacci level. Harmonic patterns. Harmonic patterns are advanced price patterns that follow very specific shapes based on Fibonacci ratios. Traders use these shapes to predict future price movements with high accuracy. A common example is the bullish bat pattern, which looks like an M shape made from 4 price swings labeled X, A, B, C, and D. Each point must follow set Fibonacci rules. For example, the move from X to B should retrace between 0.382 and 0.5. The move from A to C should retrace between 0.382 and 0.886. Each of the other points also follows its own Fibonacci guideline. To use harmonic patterns, traders watch for a 4-leg structure on the chart, then apply a harmonic tool to check if the moves match the pattern's guidelines. If they do, the pattern can signal a potential trade setup. Popular harmonic patterns include the butterfly, bat, and crab, each with its own unique Fibonacci measurements. Did I miss any strategies? Let me know in the comments. If you enjoyed this video, please like and subscribe. It means a lot. Thanks for watching, and I'll see you in the next one.